When it comes to monthly dividend-paying stocks, easily one of the most popular has to be Realty Income, ticker symbol O. The long-term performance of this stock has undisputably been impressive among both REITs and dividend stocks. This dividend aristocrat's been able to grow its dividend every year for the last 29 years, and they've experienced 103 consecutive quarterly increases. Since their founding more than 50 years ago, they become the fourth largest global REIT with an enterprise value of over $62 billion US. Roughly $7.6 billion is held in European properties, which the company has been expanding further into in recent years. But given the performance of Realty Income post-pandemic, a lot of investors have been questioning if Realty Income is still worthy of all the hype that's traditionally surrounded this REIT. People have been wondering if the company is facing more issues than just higher interest rates. For one, the share price of their stock has fallen by over 13% this year, which is far worse than the majority of their peers. Realty Income also surprised people when they recently announced a $950 million investment in the Bellagio in Las Vegas, which has received mixed responses. In today's video, we're going to examine this company's most recent moves and where they might be headed going forward. We'll also try to answer the question if Realty Income is still a good holding for dividend investors. So with that being said, let's go ahead and get started. We'll start by looking at the 5-year share price performance of their stock. Currently, Realty Income's down about 1.4% over this time, but if you account for the dividends, you'd still be looking at a positive return on your investment. You'll notice that this company's share price never fully recovered from the pandemic plunge. Before COVID, their stock was trading at around $80 per share before plunging to $42 per share. It eventually recovered to $74 in August of last year, but it has since fallen to $55 per share as of the making of this video. This makes Realty Income an outlier because many other equity REITs were able to fully recover from the pandemic plunge. If we look at the Vanguard Real Estate Index Fund, ticker symbol VNQ, we can see the majority of REITs were able to fully recover following the effects of the pandemic. VNQ's been struggling in our high interest rate environment just like most REITs are. There can be several explanations for their stock share price declining. It could be a sign that investors are losing confidence in Realty Income, or investors are selling their shares to invest in faster growing stocks in industries less impacted by interest rates for the time being. But one of the issues facing this company is share dilution. Last month it was announced that Realty Income had entered into an agreement to sell 120 million shares of their own stock to various financial institutions. This is the exact same thing they did back in July of 2021, where they also sold 101 million of their shares. This is what's known as share dilution, which reduces the value of existing investors' shares and their proportional ownership of the company. When this happens, it usually results in the share price of their stock falling because the existing shares now have less value. And the amount of shares that Realty Income is now selling is a pretty high amount. But what this company is doing really isn't anything unusual. As I've discussed a couple times in the past, this is one of the ways that REITs grow their real estate portfolios. In order for a company to qualify as a REIT, they have to do several things, which includes passing out 90% of their earnings to shareholders in the form of dividends. As you can imagine, that doesn't leave the company with too much room for growth. A REIT can raise rent on their existing properties, but that usually isn't going to result in enough money for a decent amount of consistent growth over time. So REITs are left with several different options when it comes to raising money for more property acquisitions. One popular way is by borrowing money, but as you can imagine, this isn't the most ideal thing to do right now. With interest rates being so high, borrowing money is significantly more expensive now, so it's not really a good option. Until interest rates go back down, REITs in general are going to have a harder time expanding their real estate portfolios. But what Realty Income's been doing is issuing a bunch of new shares to raise capital. On one end, it does help the company grow its portfolio and thus increase the cash flow coming in from more properties. But on the other hand, it's a disservice to current investors in my opinion, as every time they do this, it sends the share price down. In terms of what types of properties Realty Income's been going after, for the longest time they've highlighted the fact that their portfolio is a lot more resilient to economic turndowns. According to their latest investor presentation, they claim that roughly 91% of the rent they collect is safe from a downturn in the economy or e-commerce activity. You can see 11% of their properties are convenience stores, 10% are grocery stores, and 7% are dollar stores. In general, these are much safer properties compared to things like movie theaters and gyms. They're the types of properties that'll still be needed regardless of how bad the economy could get or how advanced e-commerce gets. These properties are often targeted by other REITs like WP Carey and Agree Realty. So there were some mixed reactions when Realty Income announced on August 25th that they had signed a definitive agreement to invest approximately $950 million to acquire common and preferred equity interests in the real estate assets of the Bellagio, Las Vegas. According to the press release, Realty Income will acquire a 21.9% indirect interest in the property, and Blackstone will retain a 73.1% indirect interest, and MGM Resorts will retain a 5% interest in the property. This is the second time that Realty Income has invested in the gaming sector. Back in February of last year, they also acquired Encore Boston Harbor Resort and Casino for $1.7 billion under a long-term net lease agreement with Wynn Resorts. This more recent direction the company is going isn't exactly consistent with what Realty Income has been known for. They've always been known as a company that holds more essential types of properties, so for them to start investing in casinos is a new thing for this REIT, and understandably, some people haven't been too happy about this. It's long been rumored that casinos can somewhat be recession-proof due to people trying to turn their financial lives around during tough times, but according to several studies, casinos are often hit very hard during recessions. So again, this seems contradictory to Realty Income's normal strategy. But there are a couple things worth noting about casinos, specifically in Las Vegas. Vici Properties is one of the largest owners of casino real estate on the Las Vegas Strip, and the thing about these casinos is that they typically have very long lease agreements. For example, with Vici, the average lease term is over 40 years, which is outstanding. They're typically able to raise rent on these properties at a faster rate than convenience stores and fast food restaurants. So if Realty Income is working with similar agreements that Vici Properties has with their Las Vegas casinos, this ultimately could be a good move in my opinion if they got a good deal on it. Another concern some people have is Realty Income's debt situation. Currently, 8% of this company's debt is floating rate debt, which makes it more expensive to hold in our high interest rate environment. But what's been more concerning is that this company has a lot of debt maturing next year. You can see that in 2024 they have roughly $1.8 billion worth of debt that'll probably need to be refinanced at a much higher rate. It's unfortunately bad timing for this company if interest rates don't start getting cut soon, and their higher costs will impact this company's earnings if they don't get a good deal. But let's take a look at Realty Income's most recent financial results to see how well they've been doing. In July, they reported AFFO per share of $1. Given their current dividend amount, which is 25.6 cents per share or 76.8 cents per quarter, this gives them an AFFO payout ratio of 76.8%. This means that currently their dividend is very well covered and it doesn't appear to be in any kind of trouble whatsoever. Looking over some of their financial metrics, we can see that funds from operation continues to move upward over time, and so has rental revenue. They've also continued to see growth in their book value, showing that they've kept growing bigger as time goes on. With high interest rates, share dilution, straying from their typical acquisition strategy, and debt in mind, it's clear Realty Income is having to change up some things. The share dilution is what I'm most unhappy about. I understand that this might be the better option right now to avoid costly debt, but I just wish they would slow down on doing this. I don't think any of these things indicate that Realty Income is in any serious kind of danger right now. I think what they've been doing might have a small impact on their ability to grow, but I don't think it's that serious. When I think about some of the negative effects high interest rates have been having on this stock, I like to look at the long-term performance of O. You can see throughout this company's history that there have been plenty of times where their stock share price has seen plenty of declines and sideways movements. Over time though, the company has always kept moving upward over the decades. I think these issues we looked at might result in a slowdown of growth in the short term, but Realty Income isn't in any danger and it's still been a solid monthly dividend investment, which is what I like most. When interest rates finally start getting cut, I'll be looking forward to this long-awaited recovery in REITs we've been waiting for. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.